These three institutional pillars possess the absolute power to alter global interest rates and impact economies overnight. What are the most powerful central banks running the global financial system? Category: Banking. The Federal Reserve, the Fed, the central bank of the United States, commanding the issuance of the global reserve currency. The European Central Bank, ECB, the institution managing monetary policy across the entire Eurozone for 20 member states. The Bank of Japan, BOJ, a historic institution famous for pioneering unique global monetary experiments. Save this video to always remember who structurally runs the global financial architecture. If you want to invest in any corporate business, you must analyze these three specific structural documents first. What are the core financial statements used to evaluate a company's corporate health? Category: Finance. 1. The balance sheet lists exactly what a company owns, assets, and what it owes to outsiders, liabilities. 2. The income statement tracks total sales revenue generated, ongoing expenses incurred, and net profits over a set period. 3. The cash flow statement tracks the physical incoming and outgoing movement of actual liquid cash. Want a detailed breakdown of each document? Follow for our upcoming shorts. Professional macroeconomists don't guess if a recession is arriving. They track three specific data points. What are the primary lagging and leading economic indicators used to judge a nation? Category: Macro. 1. Consumer Price Index, CPI, the absolute standard metric used to measure systemic inflation and consumer cost of living. 2. The unemployment rate tracks the percentage of the available labor force actively looking for work but lacking jobs. 3. GDP growth rate measures how rapidly the overall nation's economic output is expanding or contracting. Hit the like button if you developed a stronger understanding of macroeconomic data today. When the global stock market drops sharply and panic spreads, institutional money flees into three safe locations. What are the premier safe haven assets utilized in professional portfolio management? Category: Investing. 1. Physical gold, the ultimate historic store of value, carrying zero default risk for thousands of years. 2. U.S. Treasury bonds, fixed income instruments backed by the full faith, credit, and taxing power of the United States. 3. Stored cash, the U.S. dollar, the global reserve currency that provides immediate liquidity when markets experience forced liquidations. Where do you store your capital when the stock market gets volatile? Let us know below. Imagine getting paid steady cash by major corporations simply for owning a tiny piece of them, without ever selling shares. What are dividend stocks, and how do they build passive portfolio income? Category: Investing. Dividends are a direct distribution of a portion of a corporation's net earnings paid out directly to shareholders. They are typically distributed on a regular quarterly or annual schedule as liquid cash directly into brokerage accounts. Elite companies that have consistently increased their dividend payouts for 25 consecutive years are crowned dividend aristocrats. Share this video with someone looking to construct a reliable stream of passive income. Why are elite central banking boards around the entire world universally obsessed with this specific percentage? Why do modern economists target a steady 2% inflation rate instead of 0%? Category: Macro. A flat 0% inflation rate carries high risks of causing deflation, which freezes consumer spending and corporate production long-term. Systemic inflation above 4% degrades worker purchasing power too rapidly, destabilizing cost of living predictability. A steady 2% rate serves as the Goldilocks zone, high enough to gently encourage consumer spending today, but low enough to maintain deep economic stability. Follow Educo Global for more hidden secrets of macroeconomic monetary policy. A minor drop in equity prices is considered a normal correction, but crossing this magic percentage signals a full financial crisis. Why does a 20% decline from recent all-time highs officially define a bear market? Category: Markets. Market drops ranging between 5% and 10% are highly frequent, healthy adjustments occurring within a standard economic expansion. A deeper 20% drop serves as a critical historical threshold marking where institutional investor psychology transitions entirely from confidence to systemic fear. Statistically, crossing the 20% barrier triggers automated institutional risk algorithms, causing programmatic asset sell-offs globally. Check the current market data and follow for continuous financial cycle updates. Top global economic analysts utilize a standardized fast food burger to calculate real international currency valuations. What is the Big Mac Index, and how does it evaluate purchasing power parity? Category Macro. Created by The Economist magazine, it compares the cost of a McDonald's Big Mac in different countries using local exchange rates. The index relies on the theory that identical goods should possess identical adjusted costs globally over time. If a Big Mac in London is significantly cheaper in dollar terms than in New York, it suggests the British pound is undervalued. Share this short with a fast food lover who needs a masterclass in global trade economics. This simple mental math shortcut allows you to calculate exactly when your money will double in under 2 seconds. What is the rule of 72 in personal finance and portfolio compounding? Category: Finance. The rule of 72 estimates how many years it takes for an investment to double at a fixed annual return rate. To apply it, simply divide the number 72 by your expected annual interest rate percentage. For example, an investment yielding a steady 8% annual return will take exactly 9 years to double, since 72 divided by 8 equals 9. Try the math out right now with your personal average return rate, and tell us your doubling timeline below. Nearly 60% of all foreign exchange reserves held by global central banks are dominated by one single currency. Why? Why did the US dollar become the undisputed global reserve currency? Category Macro. Its dominance stems from the 1944 Bretton Woods Agreement, which pegged global currencies directly to the USD, which was backed by gold. Even after leaving the gold standard, the immense size of the US economy and its global military power maintained deep trust. Today, the vast majority of international commodities, most notably global crude oil, are priced exclusively in US dollars. Do you believe another currency will ever dethrone the US dollar? Let us know in the comments. Most ordinary investors can only make money when stock values climb, but Wall Street pros can profit when they collapse. What exactly is the mechanics behind short selling? Category: Markets. Short selling is an investment strategy utilized to bet directly against a company's stock price. You borrow shares you do not own from a broker, sell them immediately into the open market, and pocket the cash. If the price drops as expected, you purchase the shares back at the cheaper rate, return them to the lender, and keep the difference. Follow Educo Global for more complex trading terms explained simply. Imagine consumer prices skyrocketing while the economy is freezing and jobs are disappearing. This is a central bank's ultimate nightmare. What is stagflation and what causes it? Category Macro. Stagflation is a rare economic condition combining stagnant growth, high structural unemployment, and high consumer inflation. It shatters classic economic models which assume inflation should only occur when the broad economy is booming. It is incredibly difficult to resolve because raising interest rates hurts growth, while lowering interest rates worsens inflation. Subscribe to Master Global Economics simply 1 minute at a time. If you want to calculate how much money a business actually generates from its core operations, look past net profit. What is EBITDA, and why do corporate financial analysts rely on it? Category: Finance. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It isolates raw operational profitability by stripping away financing costs, tax environments, and accounting write-offs. This metric allows investors to directly evaluate core business efficiency across totally different corporate competitors. Save this short for your next corporate finance or accounting exam study session. Imagine buying an item for $10 in one marketplace and selling it to a buyer across the street for $11 instantly. That is a real trading strategy. What is arbitrage and how does it function in modern finance? Category: Markets. Arbitrage is the simultaneous purchase and sale of an identical asset across different markets to profit from a price mismatch. It capitalizes on temporary geographical or structural market inefficiencies across global asset exchanges. Because the buying and selling legs occur almost simultaneously, the strategy represents a virtually risk-free profit. Drop a comment. Have you ever uncovered a real-world price arbitrage opportunity? Two specific words that strike immediate panic into the minds of high-leverage hedge fund managers and retail traders alike. What is a margin call and what triggers it? Category: banking. A margin call occurs when an investor trades volatile assets using leveraged money borrowed from their prime broker. If the market drops and the asset value crashes past a required account maintenance buffer threshold, the broker demands immediate cash deposits, or they will forcefully liquidate your entire position at a massive loss to recoup debt. Hit that subscribe button for daily financial risk management tutorials. Imagine a real estate escrow process that transfers an entire apartment title automatically, with no lawyers or banks involved. What is a smart contract and how does it execute on a decentralized blockchain? Category: markets. A smart contract is a self-executing digital agreement with the contract rules written directly into immutable computer code. It runs automatically across a decentralized blockchain ledger once specific, predetermined agreement criteria are met. By removing human intermediaries, it slashes transactional costs and completely eliminates third-party counterparty risk. Follow Educo Global to stay ahead of the curve on upcoming technological and financial trends. Managing a modern nation's capital requires two completely separate hands that must function independently of each other. Why are central banks kept structurally independent from legislative governments? Category: banking. Monetary policy tools, like interest rates, dictate long-term economic stability and currency purchasing power. Elected politicians naturally focus on short-term horizons, often favoring low interest rates to boost the economy before competitive voting cycles. Separating powers prevents short-term political printing, protecting the sovereign money supply from inflation. Share this short with a friend who wants a deeper view of how global political systems interface with finance. If you are building a scalable startup, seeking capital from the wrong source can inadvertently kill your company early on. What is the operational difference between an angel investor and a venture capital firm? Category: finance. Angel investors are affluent individuals who invest their own personal private capital into very early, seed-stage startups. Venture capitalists, VCs, are professional firms that invest pooled capital managed on behalf of institutional funds. Angels prioritize initial vision and accept extreme risk, while VCs demand aggressive scaling and structured governance boards. Which style of funding would you prefer to build your dream business? Let us know below. When a corporate giant requires $1 billion to build infrastructure, they face two choices, both with massive trade-offs. What is the core difference between corporate debt and equity financing? Category: finance. Debt financing involves securing bank loans or issuing corporate bonds that must be paid back over time with fixed interest. Equity financing involves selling slices of corporate ownership shares to investors to raise immediate liquid capital. Debt retains full control but introduces bankruptcy default risks, while equity dilutes ownership but eliminates debt obligations. Follow Educo Global to learn how to analyze complex corporate balance sheets like a pro analyst. Why does a stock price shift in a $100 company alter the Dow Jones Index more than a price shift in a $50 company that is 10 times larger? What is the difference between price-weighted and market cap-weighted stock indices? Category: markets. Price-weighted indices, like the Dow Jones, allocate weight entirely based on the raw dollar price of a single share. Market cap-weighted indices, like the S&P 500, allocate weight based on the absolute total value of the corporation. In a cap-weighted index, true economic size dictates market impact, preventing single stock splits from altering the benchmark value. Check the construction weights of your personal portfolio holdings and leave a comment.